Hello, I'm Stephen from TEFAT, and tonight like to give a presentation on financial ratios and financial accounting. So I'll just line up the tripod. With ratios, it's really important not to just know the formula, but how to interpret the ratio. Otherwise, you'll lose marks if you don't give adequate interpretation of the ratio, and that's what the lecturer is looking for, a correct formula. You might lose a mark for incorrect numbers, but if you've got correct interpretation of what you've got, gives you a chance of getting at least 2 out of 3. But just try to get all the 3 steps correct: correct formula, correct calculation, and correct and adequate interpretation. Don't get stuck. Don't dawdle. Just get into it, do your calculation, get on to the next one. So we'll start with liquidity ratios. Now, a really important ratio is called working capital or operational capital. It's the difference between current assets minus current liabilities. Both those items are current items on the balance sheet, less than a year. So really important formula: working capital equals current account minus current liability. The working capital ratio is current assets divided by current liability. Okay, it's a liquidity ratio. It means how much current assets, assets on call within 12 months, like such as cash and accounts receivable, can be called upon if necessary to settle short-term liabilities, being your current liabilities. Okay, really important that. And the liquidity ratio is your working capital, sort of like operational, day-to-day, not things like non-operating income at all. It's just important today, working capital. Ability to meet short-term commitments. So an example, and most of these have got examples. The current assets on the balance of Kelly's Carpets is $30,000. That's the current assets, things like bank, accounts receivable. There is adequate cash and accounts receivable. Current liabilities are valued at $20,000. So immediately we see that's favourable. So mostly accounts payable, some salary payable. And when you see that word payable, it's indicative of a current liability. So they're the figures. Working capital is short-term operational capital, highlighting how easy it is for the business to have cash on hand to meet short-term commitments, debt and liabilities. Current assets may be needed to convert it to cash, so liquidity. Liquidity means how readily you can convert current assets to cash. So let's just do the calculation for Kelly's Carpets. Working capital is 30,000 divided by 20,000, so working capital is 1.5. Now another carpet outlet, Sharman's Carpet, in the same town, has current assets of 25,000, less than Kelly's Carpet, and the same liabilities, 20,000. So their working capital is 1.25, not as favourable as Kelly's Carpet. So Kelly's Carpet has a higher working capital ratio than Sharman's. Kelly's proportion of current assets to current liabilities is higher. They can convert current assets to liquidity available cash better. But Sharman's ratio isn't too bad. With a lot of these, I've put the same figure for a lot, so you could get a comparison. So in that one, we see that higher working capital ratio is more favourable than a lower one, and I've done this a lot because if these figures are too distorted and there's too much of a disparity between the figures, a comparison might not be realistic for some of these ratios. An investor might want to invest in Kelly's company more and will examine solvency of both companies as well. So based on that working capital ratio, that's obviously favourable for Kelly's. Another liquidity ratio is current assets minus closing inventory divided by current liabilities minus bank overdraft. When the bank lets you go into a debit balance in your account, it's like a short-term loan to the bank. It can be recorded on current liabilities, bank overdraft. The ability to pay short-term commitments that need to be paid quickly. Okay, that's that if you need it. I haven't done a calculation for that one. Some of them I just skipped. Profitability ratios. You definitely will get this. Gross profit margin ratio and net profit margin ratio. Gross profit rate equals gross profit, which is sales minus COGS, divided by net sales. So on top of not the balance sheet, the P&L statement, you start with sales minus cost of goods sold, or cost of sales. So what is COGS? Say you got a shoe shop, and at the start of the period, March the 1st, the stock on the shelf. That's your opening stock. March the 15th, you got a purchase of more shoes, an order. So you add opening stock plus the purchase from the supplier. It gives you goods available for sale, okay? And then you minus closing stock for March the 30th. And 30 days have September, April, June, and November. Or actually, it's March the 31st. So opening stock plus purchases equals goods available for sale and COGS, and minus closing stock, that's your full COGS figure. And actually COGS, because it's an acronym, it should be capital letters following the rules of English. So I'll just put a capital S for sales. So sales minus COGS is gross profit divided by net sales. So what proportion of sales is made up of gross profit? Jim's Brewery has a gross profit of $50,000 and sales of $80,000. Jeff's Brewery in another part of the state has gross profit of $60,000 and the same sales of $80,000. A state government industry analyst in the Commerce Department had a look at this ratio for both brewers because he's analysing the brewing industry in the state. Jim's gross profit rate is $50,000 divided by 80,000 equal to 0.625. So 62.5 cents in one sales dollar is made up of gross profit. You can convert that to a percentage, 62.5, simply by multiplying by 100 over 1. Jeff's gross profit rate is 0.75, so 75 cents in one sale dollar is made up of gross profit. So Jeff's sales are much more gross profit in the trading account. Gross profit percentage of Jeff's Brewery is 75%. So Jeff's Brewery has a higher gross profit rate and sales are derived more from gross profit. Gross margin equals gross profit margin equals gross profit divided by sales. What percentage of sales is gross profit? For example, 40%. Now, net profit ratio is net profit after tax in the P&L. That's at the bottom line of the profit and loss statement, the bottom line, divided by net sales. Net profit margin equals NPAT divided by sales. What percentage of sales is made up of net profit? E.g. 8%. The 92% is expenses and taxes. So so gross profit minus operating expenses gives you net profit after tax in the P&L, okay? So you've got to incur a lot of expenses to gain income on the income statement. Now the industry analyst in the example above looks at the net profit rate of the two brewers in the example above, and there should be a comma there, sorry. Both brewers have sales of $80,000. Jim's brewery has a net profit of $40,000, while Jeff's brewers have a net profit of $35,000. Jeff's net profit rate equals $35,000 divided by $80,000. So that figure is net profit after tax. That figure is sales, which gives you 0.4375 or 43.8 rounded to one decimal figure. 43.8% of sales is the component. 43.8% of sales is made up of net profit, I should say. While Jim's net profit rate is $40,000, the net profit after tax again divided by sales, which gives you 0.5 or 50% of the sales is derived from net profit, or 50 cents in one sales dollar is made up of net profit. Jeff's brewers have a lower net profit ratio and a lower profit than Jim's brewers. As Jim's net profit figure is higher, then a higher net profit ratio is more favourable. But those gross profit and net profit ratios aren't the end of the world. There's more important ratios, and working capital is one. Debt to equity is another really important one, which we'll get to later. Proprietorship ratio. What is proprietorship? Well, it's net assets or owner's equity. It's the difference between total assets minus total liabilities on the balance sheet. Proprietorship is a little bit of an old-fashioned name for net assets or owner's equity. Proprietary ratio equals proprietorship, net assets divided by total assets, which can be expressed as a percentage. Back in time, in 1978, Hillsdale Surveying Company wants a 5-year government contract for state road building and has a proprietorship of $80,000 on the balance sheet and total assets of $1 million. Parramatta Surveying has proprietorship of only $30,000 and total assets of $100,000. So liabilities are quite high, as Parramatta Surveying is a new emerging surveying company keen to get the new contract. The Department of Main Roads at the time wants to contract the surveying services to the company most likely to be a going concern to see out the 5 years to complete the contract. The proprietorship ratio of Hillsdale Surveying is equal to 80,000. So the net assets, proprietorship, divided by total assets, $1 million, it's 0.8. Looks favourable. The proprietorship of Parramatta Surveying equals 30,000. Net proprietorship, net assets divided by total assets. Oh, sorry, yeah. I might have had $1 million, but it wasn't $1 million. It was supposed to be. It was supposed to be 100,000. How? Oh no, yeah, that's 100,000. Sorry, I might have said $1 million. It's not really a huge issue. Maybe I was just thought there was an extra digit. So that's the figure for total assets anyway for Hillsdale. Gives you 0.8. The proprietorship ratio of Parramatta Surveying equals 30,000 over 100,000. The proprietorship ratio of Parramatta is 0.3. So you can see that Hillsdale has got a more favourable proprietorship ratio. Hillsdale Surveying won the contract and had it ever since. Parramatta Surveying went broke 2 years later, and 2 of the directors were found to be attempting to bribe the DMR and went to Silverwater jail for 5 years. A sad story. Return on proprietorship funds equals net profit after tax divided by proprietorship, meaning net assets. So now we've got profit in the ratio, net profit, commonly expressed as a percentage. Hillsdale Surveying had a net profit after tax of 400,000 and proprietorship net assets of 600,000. North Sydney Surveyors had a net profit after tax of 350,000 and the same proprietorship of 600,000. Hillsdale Surveying return on proprietorship funds equals 400,000 over 600,000 using that formula, which is net profit after tax divided by, let's just, I don't want to shoot my mouth off. Let's just get the formula right. Yeah, net profit after tax divided by proprietorship, yeah. So net profit is, after tax is your numerator and proprietorship is your denominator. For Hillsdale, it's 0.66 recurring, rounded to 0.67 to 2 decimal places, also 67%. While North Sydney Surveying had a return on proprietorship funds of 350,000, the net profit after tax divided by 600,000 proprietorship net assets, which is 0.58 rounded to 2 decimal places, also 58%. Not too bad, but not as good as Hillsdale Surveying. As Hillsdale Surveying had a higher net profit after tax, a higher return on proprietorship funds, it's more favourable. Obviously, a higher return net profit derived from proprietorship is more favourable. So so when you compare those two numbers, 0.58 and 0.66, Hillsdale is more favourable. So that's how we interpret that. So we mean you've got proprietorship and you want to get net profit after tax. So you're using net assets, machines, to as part of your production process to generate net profit after tax, okay? And we just look, the numbers mean more favourable or less favourable, okay? Higher is favourable, lower is less favourable. Activity ratios. Activity ratios are the effectiveness a business uses its assets. Two being inventory turnover and debtors turnover rate, or debtors, another word, accounts receivable, the more modern terms. So how much inventory is turned over in a period, and always the same period, and how much debtors is turned over and getting your debtors to repay eventually. And debtors have got a system where they get a discount at the start, like N2 10 days, and then net 30, it's got to be settled in 30, and they might get a second discount, a third discount, and then if they're late paying 45 days, they might even get a late fee. So let's just go to inventory turnover. Inventory turnover is defined as COGS divided by average inventory. Now what we mean by average inventory, you've got inventory at the start of the period, say the March quarter, January the 1st, and you've got a closing balance of inventory March the 31st. That's the March quarter. So you get the inventory at the start, the inventory at the finish, you divide it by 2, that's your average inventory. So inventory turnover rate equals COGS, which I defined before, divided by average inventory. How many days inventory turned around, average inventory equals opening stock plus closing stock divided by 2, as I mentioned. Inventory turnover rate equals COGS over average inventory. How many times the company turns over its inventory expressed as a number of days. E.g. Dubbo lawnmowers, well actually the number of days isn't the result just yet of inventory turnover, that formula gives you cycles of inventory in a year, right? Then you can get the days that inventory is sold. So Dubbo Lawnmowers has a COGS of 2,000 at the start of the financial year. There were 35 lawnmowers in the shop, and at the end of the quarter, the start of the financial, this is the September quarter, 1st of July to September the 30th. There were, so at the start, 1st of July, there were 35 lawnmowers in the shop, and at the end of the September quarter, September 30, there was 50 available. So the inventory turnover rate equals COGS, quite a low COGS, 2,000 actually, divided by 35 plus 50 over 2. Work that out first, find out what the denominator is in brackets, and then put it in your calculator, and we find when we round it to a whole number, the inventory turnover rate is 47 cycles of inventory per year, right? Now we can get the number of days it takes a lawnmower. What you do is you simply, number of days stock held, you simply divide the number of days in the year, 365 divided by inventory turnover, 365 divided by 47, that gives you 8 days to sell. That means a lawnmower is sold every 8 days, okay? And say in a different example, you had 6 for your inventory turnover rate. Well, you divide 365 by 6 cycles a year, and it takes 61 days to sell that item, whatever it is. That's separate to Dubbo lawnmowers. Debtors turnover equals your debtors account divided by average daily credit sales. Credit sales being different to cash sales. We're talking about credit sales. Another word for debtors, of course, accounts receivable, AR. The times per year, the cycles of debtor collection. So the debtors turnover rate, ability of the business to collect money from customers who have paid on credit and accounts receivable. The goal of the company is to get money back from all your debtors, cash eventually. It's like a short-term loan to other people, but some people are a bit doubtful on paying doubtful debts. That's doubtful debts expense is a type of expense in the P&L. Sometimes people just don't pay bad debt, and that's another expense in the P&L. But most people do pay in the end, right? Let's just not focus on that. Debtors turnover rate equals debtors over average sales. Sales divided by 365. And I should have that in the earlier formula too. So let's just fix that up. Sales divided by 365. That'll probably help you, because it'll just help you remember the formula. Debtors, try and say it without looking. Debtors over your average sales. What is average sales? Sales divided by 365, the number of days in the year. So you got your form, you're clear on your formula, just go ahead and do it. And in this example, this might have been from McGrath and Walsh actually. Yeah, it is. McGrath and Walsh 95, my textbook from TAFE, page 181. Average collection period, yes, so they had 90,000 for, what is it, the numerator in the formula again? It's debtors, that's right, over average sales. So debtors in your numerator, 90,000, divided by your average sales, 730,000, right? And so we get let's get our calculator out, because we don't want to go in all guns blazing. Let's firstly find 90,000 divided by 730,000. That's 0.12, right? And so 365 divided by, sorry, I'll just write this on a piece of paper. 90,000 divided by 730,000 equal, you calculate it too, 90,000 divided by 730,000, 0.12, okay, and so then we go 365 divided by 0.12. Oh no, actually that isn't. There's something wrong here. I'm going to refer to McGrath and Walsh. It's page sorry, there's something wrong with that. I'll have to fix it up. I'll fix it up in my own time later. I'll just read from the textbook, and McGrath and Walsh are in my sources too. I've just taken one of their questions, that's all. Page 181, just quickly. Sometimes you'll get stuck on at least one ratio, that's fair. And must be another one. Yes, sorry, it's actually another textbook, not that one. It's actually McGrath and Royal. I'll have to change that in the source. 181. Oh no, it's not McGrath and Royal. Oh, hang on. Under a bit of pressure here. Analysis 367. 367. I like being under pressure. It shows my mettle. It's debtors turnover. Here it is. Okay. So, sorry. First you get to find average. So now I know it where I went wrong. You've got to divide 730,000 divided by 365. I have said that, but I haven't executed it. So find that first, the numerator, divided by 365. That gives you 2,000. So 90,000 divided by 2,000. 45 cycles. That's actually not days, it's cycles. Cycles of debtors repayment. And then now you can get the days. So you go 365, so you got 45 cycles divided by the 45 cycles. That means your average collection period is 8.1 times a year. Oh, so yeah, that's your cycles, rather. Yeah, sorry, I'm getting all this wrong. That's 45 days, the original thing. Yeah, that's the time it takes to collect debtors, which isn't very impressive. That's over a month. And then you get cycles by 365 divided by 45 gives you 8 cycles in a year. So I nearly made a terrible mess of debtors turnover rate, but have a look at yourself, and it is McGrath and Walsh. Actually, it's 381. I got the wrong page. 381. Let's just move on, because sometimes you get a bit stuck. Investment return ratios. Return on investment ratios is return on assets equals net profit after tax over total assets. Yeah, that's a fairly important ratio. The ability to return income on assets. Farmer A returns a net profit after tax of $250,000, while Farmer B gets $300,000. Both have net assets of $300,000. That's the denominator. So Farmer A return on income on assets, how he uses assets to generate income, equals $250,000 divided by $300,000, gives you 0.83 recurring of 83%. That's quite favourable, actually. And Farmer B return on income and assets is 300,000 over 300,000. So when you compare those two farmers, actually Farmer B has got a higher return, net profit after tax, equals 1 or 100%, a little bit unrealistic. So Farmer B has more return of income on assets. Farmer A knows Farmer B, they're in the same town, and they meet at Joe's agricultural supplies in the local town. Joe and Farmer B convince Farmer A he doesn't need more machine, but needs to change his combination of fertilisers to increase agricultural yield and profits. So from that ratio, we got a question, well, we're about the same acreage, why is your net profit after tax higher? Well, Farmer B was doing something different, that he was advised by a consultant at the agricultural supply to put fertilisers in a different combination. So that initial ratio prompted thought of an improvement. Return on shareholders' funds equals net profit after tax over opening balance of shareholder funds, right? Shareholder funds being how much shareholder capital, how much capital shareholders have invested. An investor, Len Smith, knows about the adhesive industry and compares two adhesive manufacturers who both supply adhesives to a national hardware chain. Gluam Adhesives returns a net profit of $330,000, and Stick-It-On Adhesives gets a net profit after tax of $380,000. So Stick-It-On gets more net profit. Both manufacturers have an opening balance of shareholder funds of $1 million. Gluam Adhesives return on shareholder funds is $330,000. Net profit after tax divided by $1 million, which is shareholders' funds, which is 0.33 or 33%. So that that share capital is really important to generate net income, okay? While Stick-It-On Adhesives return on shareholder funds is $380,000 net profit after tax divided by that figure for shareholder capital, which is 0.38 or 38%. So that's a higher return on shareholders' funds than the other company. Now you might think Len Smith may instantly decide to invest in Stick-It-On Adhesives, but he also calculates earnings per share, which we'll get to, and includes another calculation, and Len Smith just thinks that the other company, another company, Glue It Tough, had a better EPS. So you look at a lot of ratios. You might have a list of 6 or 10, and you analyse the stock or the impending investment, and you use a combination of ratios, right? So you just don't choose one or two. Have a tick list of a lot of these ratios. Asset turnover. This measures how assets are used to generate sales. You compare figures to industry standards, and actually with a lot of these figures they're there's an industry average or a state average. It could be a geographic area. It could be a regional average, or you're just comparing, using these ratios to compare company A and company B and then company C. So there's a number of ways you can compare these, and I'm sure the Australian Bureau of Statistics has got some of these in their accounting section. So total asset turnover is sales divided by total assets. Gosford Glass is considering a takeover of Wyong Glass. Both companies have a total asset figure of 200,000. Gosford Glass has sales of 100,000, while Wyong Glass has sales of 70,000. Gosford Glass has total asset turnover of 100,000, which is, let's just refer to the formula again. It's sales over total assets, right? So sales is your numerator, a 0.5 or 50%, while Wyong Glass total asset turnover equals sales over net assets, gives you 0.35 or 35%. So Gosford Glass is more impressive. Higher sales generated from their total assets. Using your total assets to generate income, your machines, your tractors, your cars. So assets on the balance sheet, you need them, you need machines, you got to pay liabilities for the machines to get the net profit. You can't just run a business on buying postage stamps and the P&L. You need machinery to be a manufacturer. So higher net total asset turnover for Gosford Glass. A representative of Gosford Glass meets the management team at Wyong Glass, who disclosed that another manufacturer in the northern Central Coast has set up 5 years ago with cheaper imported materials, who is taking the edge of their sales. Gosford Glass decides to take no action on the buyout, but it's got them thinking, perhaps we should be importing the cheaper materials as well, to take from Southeast Asia, to take advantage of free trade. There hasn't been a tariff on glass manufacturers for decades, and the last one was lifted by the federal government back in 1982. Just fictitious, by the way. Please don't look up the economic history books. It's just an example. So again, the ratio analysis got them thinking, and there was an improvement. So that's a good result, a good outcome. Fixed asset turnover equals sales over average fixed assets. Do you know what fixed assets are? They're non-current assets, right? As opposed to current assets, which are like variable assets, okay? So that's what fixed assets are, non-current assets. They're assets that are used for longer than a 12-month period. Say sales in a company was 800,000 and fixed assets in the beginning of the period was 900,000, and fixed assets at the end of the period was 1.1 million. And you're always using the same period if you're comparing two companies. So you've got to find the average, the difference between opening fixed assets and closing fixed assets, your non-current assets. That's the denominator, right? So put all that in brackets, do that first, then use your calculator, maybe write it on a piece of paper, the two figures, simply divide, and you'll get 0.8 or 80% fixed asset turnover. That ratio is really important with entities that have got high sunk costs in non-current assets, substantial machinery, okay? So they would be interested in this ratio. A corporate entity that's very capital intensive, okay? Iron smelting or aluminium smelting, those sort of businesses. Yeah, I'm just repeating myself there. The company may manage its fixed assets well to use those to get sales. A high ratio is more efficient than a low ratio, okay? Now, I like this one, as asset employee ratio. I like my example. Let's just define it first. Asset employee ratio equals total assets on your balance sheet divided by total number of employees in human resources. And it's let's try and unpack this. It's how employees combine with capital, but perhaps a capital to labour ratio from economics to give effective results for the company. You're seeing if the company is capital intensive or labour intensive, and in economics, countries can be capital intensive or labour intensive. Often third world developing countries are labour intensive. So back to business. Is the firm labour intensive or capital intensive? And perhaps if we realise something that's unfavourable, perhaps too much reliance on labour, perhaps we should be improving the investment in capital, machinery. Okay, so that's how we use that ratio, total assets divided by number of employees. If a high dollar value of assets, then the capital is capital intensive, all right? But if they only have a few machines and a lot of labourers, obviously they're labour intensive, but you still need a combination of both. In Kenya, which is a developing country, agricultural labourers are still used for harvesting. But Farmer B has spent $200,000 on a machine which can replace labourers in harvesting. For example, sugarcane. Farmer A has $100,000 in total assets and 8 employees. So he's got 100,000 in assets. This farmer's got 200,000. And my example is they both have 8 employees on the farm, right? This guy's got more assets. He's just invested in more machinery assets. So Farmer A asset employee ratio is 100,000 over 8, which is 12,500, but Farmer B asset employee ratio is 300,000 on 8, gives you 37,500, right? So let's just see if the example's authentic. Did I put Farmer B? Yeah, Farmer B has got a more capital intensive, that's correct. So that guy has got more assets, he's more capital intensive. Eventually all the agricultural operations in the East African region will use mechanical harvesters to replace agricultural labourers to catch up with the developed country, which use mechanical harvesters. Back home to Australia, if you're in Australia in the 1950s, sugarcane in northern New South Wales and Queensland was still cut using blokes with machetes, cane cutters, who lived in cane cutter huts, and they had 5 months off each year. It was back-breaking work before the days of machinery. Ray Lawler, the playwright, wrote a play about cane cutters called Summer of the 17th Doll, which was first played out in Melbourne in 1955, when cane harvesters had a 5-month break. They worked hard and played hard. The first mechanised sugarcane harvester was demonstrated in Australia in 1924, but it wasn't really commercialised in Australia until the 60s. By 1974, about 98% of sugarcane was harvested mechanically. So even in 1974, 2% of the industry harvesting was still done by cane cutters, big blokes with machetes. I find that amazing. My source is Railway Research Society of Australia, Inc., and that's the website there. And I cited this, I better put it, the citation date, cited October, was only 2 days ago. Today is the 29th, so it was the 27th of October 2021, the COVID lockdown year. We're just out of lockdown. So that's that. Profit per employee equals net profit after tax over the number of employees. How much net profit after tax each employee generates. Profit per employee equals net profit divided by a number of employees. So an example, each employee generates $200 profit. So I like this example as well. 2 recycling companies have 16 employees each. Green recycling and good for the planet recycling, but green recycling consistently turns out over a net profit after tax of about $400,000, while good for the planet consistently yields about $500,000 net profit after tax. So good for the planet is going better, and both are contracted to 3 Sydney local councils. And remember, bear in mind that they both have 16 employees in the ratio. Save the Future Recycling.org is a powerful lobby group with an ear to politicians and the media coverage. Save the Future wants to know why good for the planet is returning higher profits. Save the Future has a volunteer, Jenny, who graduated in finance, who calculates the profit per employee for each company. Green recycling profit per employee equals net profit after tax divided by the number of employees, which gives you 25,000, right, per employee. And good for the planet, they're getting, for each employee, they're getting 31,250. What's the difference? Because both have similar operations. So again, using the ratio to get you thinking. Jenny meets the manager at Green Energy, and their conveyor belt system and computerized dispatch system for recyclables is good, dropping the recyclable in the correct container, which is impressive, as well as a good cleaning system of recycles and reheating the plastic and shaping it into plastic beads for reuse. A week later, Jenny visits the other company, Good for the Planet. They have a similar operation, but their dispatch system is still done by hand compared to Green. The technical manager will investigate this technology later of the other company when he gets a chance, but the technical manager explains that each employee visits a local school. This is the second company, for a 60-minute seminar on how to recycle correctly, with information such as taking metal caps off glass bottles to improve recycling. Each employee gets a Working with Children check with Service New South Wales to visit the schools. The seminars are successful because the children tell their parents and brothers and sisters. The local newspaper printed a story about these successful seminars at the school between Good for the Planet and the schools. The council notices that recycling techniques are steadily improving. It's win-win for the community, including stakeholders. Jenny goes back to Green Recycling to inform them of what Good for the Planet has done. The team at Green think it's a good idea and will trial the seminars at schools and get in contact with the local school principals. In turn, the local newspaper publishes a story, and there are results. 2 years later, Jenny goes back to Green Energy and recalculates the profit per employee figure, which has improved substantially, nearly as good for the planet. The story gets some time on the ABC television show, the 7:30 report. Again, it's win-win. Just a fictitious example. Leverage ratios. Measuring how effectively debt is used to result in assets, then equity. How effective is this transition? Firstly, debt to equity ratio equals long-term debt divided by shareholder funds. If debt is too high in the numerator, there is a risk of liquidation when you compare it to shareholder funds. If that's low, that's another lopsided ratio. Also, if a firm is too highly levered to debt rather than equity, their loan application to a financial institution may be declined. If a firm has a favourable debt to equity ratio, they have substantial assets, they may find it easier to get a new loan and finance and debt capital. We are comparing debt dollars for equity dollars, which can be boiled down to $1 and what the cents of debt is to $1 of equity, okay? So say debt is 60 cents in one equity dollar, we're comparing the two. Now the example. Two taxi cooperatives, Mudgee Taxis and Dungog Taxis, are compared by the New South Wales Taxi Council. Both cooperatives have shareholder funds of $300,000, but Mudgee Taxis has debts of $200,000, while Dungog Taxis has massive debts of $800,000. They have been struggling for years, and their current loan application is the last throw of the dice. In addition, and I should have a semicolon here, sorry, Hunter Valley Bank must make a decision who to lend to, their opportunity cost as lenders, deciding between the two. Because both Dungog Taxis and Mudgee Taxis have made a loan application, they can't lend to both. And the loan is $100,000. Mudgee Taxi debt to equity ratio is $200,000 over $300,000, which is 0.66 recurring, or 67%, which means their debt to equity ratio, debt is 67 cents in one equity dollar. Still pretty high, but have a look at the books of Dungog Taxis. Now Dungog Taxi debt to equity ratio is 800,000 debt over 300,000 equity. That's out of proportion. That's actually more than a whole number, 2.66 or $266. That means debt massively outweighs equity. That means Dungog Taxis has $2.66 debt for each $1 of equity. If Dungog Taxis don't settle their debts in the intermediate period, given their equity, they are doomed. They're at risk of folding. They probably are insolvent now. And anyway, Hunter Bank decided to lend to Mudgee Taxis, which was the sensible decision. The Taxi Council predicted that Dungog Taxis would be left to financial oblivion. Sad, because Dungog people would be left without a taxi service, and the taxi cooperative had a proud business history since 1953. But recent events caught up with them. Rideshare set up in Dungog, and the local council even provides a ratepayer subsidised minibus to the North Coastline. Now, total debt to total assets. Total debt to total assets equals total debt over total assets. Proportion of assets financed by debt rather than shareholders. Internal finance. So debt capital rather than internal financing. Maybe assets will be needed to convert to debt. So total debt over total assets is total debt to total assets, total debt numerator, total assets denominator. Say Monavale Boat Builders has a debt of $900,000 and total assets of $1 million, while Newport Boat Builders has a debt of $1 million and also total assets of $1 million. When you compare the two boat builders, you find that Monavale Boat Builders' total debt to total assets ratio equals 900,000 over a million, which is 0.9 or 90%, which means 90 cents of debt is matched to total assets of $1, 100 cents. Pretty high, but Newport Boat Builders is even worse. Found its total debts to total assets figure as a million over a million, which is 1. So that means debt and total assets are equal. That's alarming. That's unsustainable. If Newport Boat Builders found that equity was greater than debt, they'd have a bit more wriggle room in this situation. You, as a customer of a boat, you take out a contract with one of these, who are you going to go for? You're probably going to go for Monavale Boat Builders just on the basis of that. Newport Boat Builders could fold, leaving you with a half-finished boat in their shed. Maybe they will sell to another boat builder, but maybe not. Might not be restructured for 5 years. You'd rather go with the safer boat builder, looking at their books. Debt to operating cash flow. Debt to operating cash flow equals total debt divided by operating cash flow. Operating cash flow being a section in the cash flow statement. The other two being investment and financing cash flows. So operating cash flow is really important for day-to-day operations, calling on that to settle short-term to intermediate debts. The time it takes to redeem debt from operating cash flow. An accounting lecturer at ANU asked in a class, what is debt to operating cash, and wants a student to interpret the ratio. The company Tuggeranong Fasteners is compared to Belconnen Fasteners. Both companies have operating cash of $300,000. Tuggeranong Fasteners has a debt of $200,000 and Belconnen Fasteners has a debt of $150,000 debt. So the debt to operating cash flow of Tuggeranong Fasteners is $200,000 over $300,000. So that's the debt, that's the operating cash. Let's just double check. Yep, debt on the numerator. Correct. Debt is, total debt is the numerator, operating cash flow is the denominator, which is 0.66 or 67%. The debt to operating cash ratio of Belconnen Fasteners is $150,000 divided by $300,000, which is 0.5 or 50%. One student says, while either company wouldn't use all the cash to service debt because it needs the cash for operating, investment and financial uses. So you're not just going to use all your cash to service the debt in one day. You'll need that cash for other uses. You will pay off the debt over time. The accounting lecturer replied to the student, you're certainly on the right track, but you've forgotten to state how many estimated years the company will service the debt. He picks up a piece of chalk and writes on the blackboard for Belconnen Fasteners, divide 1 by that ratio, 0.5, which is 2. So Belconnen Fasteners should be able to pay the debt in about 2 years, everything being equal. Remember, this is debt to operating cash flow ratio. Some students calculate the time for Tuggeranong Fasteners to pay the debt in their own notebooks. It's 1 divided by 0.67. And one student puts up his hand and says, so it takes approximately 1.5 years for the other company, Tuggeranong Fasteners, to pay their debt. The lecturer points at him and says, you're right on the money. Now, times interest coverage ratio. This is a really important one. You've got to get this right. Times interest coverage ratio equals earnings before interest and tax, right? Divided by interest payments on loans. how these earnings are used to meet interest payments. Now, usually it's not a problem, high earnings before interest and tax, but if that figure of earnings before interest and tax gets low, you could start, that starts affecting operating cash, and maybe if it's 1/1 in the numerator denominator, you're just paying your interest payment. That's unsustainable. It'll fold. The same lecturer asked that student to come to the blackboard to calculate times interest coverage as an example. Make up your own example, he says, and your own numbers. The student says, okay, I'll do one for Belconnen Fasteners. He wrote the formula times interest coverage equals earnings before income and tax. I think I just pressed the keyboard. Divided by, he forgets the denominator, and a young lady exclaims, divide by interest. EBIT is operating income, which excludes tax on the interest bill. Oh, sorry, that I should put, that's correct. Investors and lenders look at non-operating income as well, but that's a bit of a sidetrack. The student at the blackboard says earnings before interest and tax are 200,000 and the interest bill for the year is 20,000. Now go ahead and divide 200,000 earnings before interest and tax divided by interest payments. He uses his smartphone calculator and comes up with the number 10. Then the accounting lecturer asks him, what does this mean, 10? The student gets a bit stuck and asks another student, please assist me. Another student explains she only read this last night and it's the ease of a company to service interest payments and meet short-term obligations to keep solvent. If they don't, it could drain the finances of the company if that figure is too low. The lecturer asks, could you calculate times interest coverage if interest rates are still 200,000 but earnings before tax and interest is lower at 100,000? Well, that's an easy one. 180,000 divided by 20,000 gives you 9. The lower times coverage, and I've got that twice, sorry, isn't too bad and not much different to the other ratio. No alarm bells here, but when are there alarm bells? We'll just get to that now. Now, one student looks up Investopia on his iPhone with headphones and he listens to a short 1.5 minute presentation, and the presenter says that if times interest coverage gets below 1.5, it's a warning sign that the company may become insolvent. If as I said before, if their times coverage ratio is 1, that means they're only paying their interest payments. Obviously, that's unsustainable for the long term, and they'll probably fold, you'd think. And they haven't got enough money for operating expenses, okay? So which bank, financial institution, is going to give them a loan? They'll either foreclose, or if they're lucky, they'll get a buyer and consolidate their books, consolidated financial statements. Another ratio, fixed charge debt service coverage equals EBIT plus lease obligations divided by interest payments plus lease obligations. I was never really interested in that ratio, and I wasn't even asked a question on it. I didn't give an example. Market valuations by investors, dividend yield percentage. You might get asked this. Dividend yield is dividend per share divided by current market price of share expressed as a percentage, okay? Earnings per share, EPS, shows net profit after tax made on each ordinary share dividend. Ordinary meaning an ordinary share, not a deferred share where they're paid later, or a preference shareholder where they're paid first. just a normal old ordinary shareholder, okay? So what's the formula? Dividend yield equals dividends per share, DPS, divided by current market share, multiplied by 100/1. Compare to similar industry averages and get the same period, okay? Or compare this to other companies. On the Australian Stock Exchange, you have information that a new technology company, Solar Batteries, pays an average of 8 cents a share, and the share value might go up in value. It could be a capital growth stock. The share price is only 20 cents a share. You were thinking of investing also in a building supply company, Build It, which is a mid-cap, at $32 per share. The dividend is $14 average dividends per annum. Usually you have an interim dividend, a final dividend. Sometimes you even get a special dividend. So $14 is for the whole year. That's a combination of both the interim and final dividend, okay? There's no blue chip shares considered here, but he thinks about Commonwealth Bank of Australia, but the shares are over $100, around $106 or $107 a share, which is a bit out of his budget. Solar Batteries dividend yields is 8 cents over 20 cents, which gives you 0.4, which is 40%. Build Up dividend yield, the building company, supply company, equals $14 over 32. So that's your dividend per share divided by the share price, right? That's the share price there, which is 0.4375, which is 44%. So not much different to the other company, a bit higher. The higher dividend yield, the better. As the dividend is similar, the investor is thinking, I'll take a bit of a risk that the solar battery share price will go up. So he invests in the technology stock. Earnings per share, EPS, you will get this. It's equal to net profit after tax less preference share dividends. So you're taking preference shares out, divided by the total number of ordinary shares in a quantity that is not a monetary value, the denominator. It's the number of ordinary shares. So again, earnings per share equals net profit after tax less preference shares divided by total number of ordinary shares expressed as a quantity. That's the formula for EPS. You use that in the price earnings ratio too, which is next. A proprietary limited company, Tempe Records, has 150 shareholders and records a net profit after tax of $300,000. They're a private company. And preference shares of 15,000. Earnings per share equals 300,000, the net profit after tax. Take out your preference shareholders, divide by your total number of shareholders, gives you $1,900 per share, which is your EPS. Now, price earnings ratio. It's how the market rates the share. It's found by the current market price. Okay, look, what's the formula? Okay, the formula for PE ratio equals the current market share price divided by earnings per share. Right? That's the formula there. You could put a rectangle around it if it was a whiteboard. It's the current market share price, okay, divided by EPS. And we've just found EPS. Back to the EPS formula. Just going back a bit. Remember that EPS is net profit after tax less preference share dividends over the number of ordinary shares, okay? So you've got that. Now that EPS becomes denominator in the price earnings ratio, okay, with numerator being the current market share. Tempe Reca's shares are valued at $5,000. Many shares were originally purchased at a low price when the company was formed many years ago, back in the 1970s, and some of the original shareholders are now deceased and passed on their shares to their sibling in legal wills. So we know the value of the shares is $5,000, right? That's pretty high, actually. Yeah, but it is what it is. A share might cost you about $30 or something, and 20 cents from the example above, but here it is. The price-earnings ratio for Tempe Reca's is the value of the share, $5,000, divided by $1,900. That's the dividend each year, which is 2.63. So the share price, $5,000, is paid after 2.63 cycles of dividends, right? Okay, nearly 3 actually. Nearly 3 dividend payments gets you the market price, again made up by dividends. Say you got a PE ratio of 7, right? This means 7 dividend payments are required to make up the share price. That's what we mean by price earnings ratio. It's another really important ratio. Yeah, you'll probably get price earnings ratio. A low P/E may indicate slow growth. A high P/E is indicative of good performance. However, there could be factors in the macroeconomy and microeconomy at the industry level which could affect EPS. Exogenous factors outside the scope of internal factors being endogenous. Now, finally, earnings yield is the reciprocal of the price-earnings ratio. Earnings yield is derived by earnings per share, EPS, divided by market price times 100 over run. Tempe Reca's earnings yield equals Tempe Reca's EPS divided by Tempe Reca's share price times 100 over 1. EPS is $1,900. Tempe Reca's share price is $5,000. Tempe Reca's earnings yield equals $1,900 divided by $5,000 times 100 over 1. What is Tempe Reca's earnings yield? It's equal to 0.38 times 100 over 1, which is 38%. A low ratio could be an undervalued stock, while a high earnings yield could indicate an overvalued stock. By my reckoning, you aren't really comparing earnings yield between two companies so much as comparing earnings per share to share price within the same company to see if these figures change. Now, finally, we're getting to the end of this. We've already covered proprietorship ratio, but just bear in mind that in the categorization, this is an equity ratio. Okay, now, these are my sources. McGrath and Walsh, the book I used at TAFE in the mid-90s, Applications of Accounting Procedures Workbook, National Core Accounting Publications, 1995, Sydney. I chose a question from there. Light Railway Research Society of Australia. I found that really interesting. I doubt you'll look that up. I just put it in context of one of the ratios. It was the one about capital intensive and labour intensive production processes, and you get those in economics as well. And in Investopia wasn't too bad. I got clarification on a couple of things there. Right, so that was a long presentation. It's quite a lot of work, financial ratios. I remember I had this Brazilian student once, and he just said to me after, well, we've hardly done anything. And I said, listen, mate, we have to do this properly. First, you have to define the formula, right? Get correct calculations and interpret it. He didn't want to do that. He wanted to do everything in 5 minutes. You can't do that. You've got to just be structured and methodical rather with financial ratios. If you just get the formula, the calculation, the correct interpretation, you should be okay. I mean, financial ratios aren't too bad, and the formulas are easy to remember, and you can get some easy marks on multiple choice or short answer questions. So, I mean, just spend some time working on financial ratios and you should be okay. And thanks for watching this long presentation. Bye now. Oh, sorry, I forgot to say, I'm Stephen from TEFAT. It's Trifolium Economics and Financial Accounting Tutoring, and there's a Gumtree ad and a website, and I've got other presentations. Sorry about the delayed goodbye. It really is a goodbye.